Morning, everyone, and welcome again to Invest Expo 2025. So my name is 𝗪𝘃, and I'm with the research team. So earlier today, 𝗪𝘆𝘀 mentioned about semiconductors as one of the sectors that we are immensely positive on. So today, that's what I'm going to be talking about. So it is also one of the sectors that we think will continue to do well in the years ahead. So even though we have shared about this sector multiple times before, and for many years now, there always seems to be something new going on in this space, and I believe that many of you here, you are still interested to find out what the latest happenings are, especially for those of you who own stocks within this sector. So without any further ado, let's dive right into it, starting with a look at how share prices have performed. So the past 5 years, it has been nothing short of spectacular for chip stocks. As you can see from this chart, between the beginning of 2020 to the end of 2024, share prices of semiconductor companies measured by the VanEck Semiconductor ETF, they have surged by more than 234% on aggregate. So this also means that if you have bought and held throughout these 5 years, you would have made close to 3.5 times your initial investment. Not too bad, right? And if you look closely, in 2024 alone, semiconductor stocks, they actually rose by 43%, outpacing the broader S&P 500, and also even the broader US technology sector. So this outstanding performance underscores investors' unwavering confidence in the chip-making industry, which till this day continues to play a pivotal role in driving technological innovation and also shaping the future of global markets. And beyond share prices, the fundamentals of the industry also reveal a strong outlook for the semiconductor industry. So if you look at the sales figures, you can see that the industry remains in an upcycle, delivering robust double-digit sales growth over the past 3 quarters. And earlier in November of 2024, chip sales actually reached a record high of $58 billion. So this marks a significant turnaround from what I shared back in Expo last year, where the industry, it was still in a down cycle, and sales growth, it was still deeply negative. So this recovery in sales, it has no doubt played a positive role in generating share price movements across the sector in 2024. And looking ahead, what we believe is that sales growth, it will continue to accelerate, and that should in turn drive share prices even higher. So I'll state for the record now that for semiconductors, we are going to reiterate our view that it is going to be one of the top performing sectors over the next few years, and in the next few slides, I will attempt to convince you why. So first and foremost, underpinning this prediction that semiconductors are going to be one of the best performing sectors is our investment thesis that semiconductor companies, they are going to see a massive structural increase in demand as the world becomes increasingly tech-driven, which will lead to, number 1, more semiconductor applications, and number 2, higher silicon content. So these days, the use of semiconductors, it has become widespread. You can find them everywhere, inside the watches that you wear, the phones that you use, the cars that you drive, or perhaps even your coffee machine. And as the number of smart devices continues to increase each day, demand for semiconductors is bound to increase as well. And aside from the growing number of end-user applications, rising silicon content is also another important factor that will drive chip demand further. So in one of Micron's recent earnings calls, the company has actually shared that PC manufacturers, they are starting to roll out PCs with AI capabilities. So these AI-enabled PCs, they require additional DRAM content with a minimum of 16 gigabytes for the entry-level computers to as much as 24 gigabytes for the higher-end segment, and this compares to the current average of just 12 gigabytes. Secondly, in the mobile space, AI-enabled smartphones also continues to be a strong driver for mobile DRAM content growth. So if you look at the table on the right, you can see that the 2 latest generations of Apple's iPhones, which are your iPhones 15 and 16, they feature Apple Intelligence, and they have significantly larger DRAM capacities compared to their predecessors. And the iPhone 17 Pro, which is expected to be launched later this year, it is rumored to come with 12 gigabytes of RAM, which is actually 1.5 times more than the iPhone 16. So if this is true, then things are actually progressing way quicker than what we have anticipated. So from a broader perspective, chip demand is also going to be bolstered by structural megatrends such as AI, which we think is the biggest development that this sector has seen since the arrival of smartphones in the late 2000s. So recognizing the vast potential of AI, many big tech companies, they have ramped up spending, purchasing billions of dollars of AI chips, and this surge has contributed immensely to the fortunes of companies like NVIDIA, which saw its data center revenue reach a record high of around $31 billion in the third quarter of last year. So the good news here is that global spending on AI, it does not appear to be slowing down. Big tech companies, they are still pouring massive amounts of money into this space. And if you look at the chart on the right, you can see that the combined capex of the 4 largest internet companies in the US, it is expected to grow by more than 15% this year, and that is after rising by more than 45% back in 2024. So most of this money, obviously, it goes into purchasing GPUs and other chips, research and development, and building data centers. So there's no denying that AI is important, but beyond AI, there are still many other segments that are also contributing to chip demand, and the auto industry is actually one of them. So cars, if you recall, they are predominantly mechanical in the past, and it wasn't until the mid to late 20th century that electronics were first introduced for simple functions such as your radio, displays, so on and so forth. But these days, we have autonomous driving vehicles that are capable of moving from point A to point B, all without human intervention. So cars with higher levels of automation features, they typically require more semiconductors for cameras, sensors, and radars for these things to function. And this will also be a key driver of semiconductor content growth going forward. Furthermore, in the recent years, electric vehicle sales have also grown rapidly due to factors such as environmental consciousness, policy support, and even changing consumer preferences. So estimates show that global EV sales has actually reached a record high in 2024, accounting for roughly 20% of the total vehicle sales worldwide. So this has also led chip makers to become increasingly optimistic about their prospects within this sector. Infineon, which is one of the companies that are big in the auto chip space, it predicts that the cost of semiconductors in a typical EV, it is going to increase by more than 50% between now and 2030. And as more chips are used for features such as your autonomous driving, power management, or even your entertainment features. So these are all examples of how rising silicon content is adding to chip demand in the auto industry. So in addition to all these structural megatrends, semiconductor companies, they are also benefiting from the significant support from the public sector. So governments worldwide, they are pouring substantial resources and funding to bolster the industry after recognizing their strategic importance, both in terms of economic growth and national security. So of course, in the US, I think many of you would have heard of the CHIPS and Science Act, which is something that was initiated by the Biden administration as part of a broader effort to bolster US competitiveness in semiconductor manufacturing, particularly in the area of advanced chips. And that is one area which is currently dominated by Taiwan today. So with this act, the US aims to produce roughly 20% of all advanced semiconductors by the year 2030. And as of August of last year, the White House has reported that roughly 32 out of the 39 billion US dollars in direct funding has already been disbursed, and it remains on track to allocate the remaining funding by the end of the year. Europe also has a similar act, which aims to strengthen the continent's tech leadership and to address any future semiconductor shortages. Moving on, in Asia, China has also made the development of its domestic semiconductor capabilities one of its biggest national priorities, and this comes after suffering intensifying sanctions by the US. So in the recent weeks, you may have heard that the outgoing Biden administration is making a last-ditch attempt to tighten export controls to China after finding out that some of the chips that were previously banned from exporting were actually found in Chinese-made products. So in China, support from the central government, it comes in the form of a national fund, which has raised a combined total of around 40 billion US dollars in the first 2 phases. So right now, the fund is currently in the 3rd phase, and the investment is expected to be close to 50 billion US dollars and will run from today to up to 2039. And also, Japan is also undergoing its own chip renaissance, marked by renewed investments from both the public and also the private sector. So the Japanese government has collaborated with major Japanese corporations to create a company called Rapidus, which is a homegrown chip maker with the ambitious goal of producing 2-nanometer chips by the year 2027. So alongside the other structural factors that I have mentioned earlier, the extensive government support also serves as another important catalyst for the chip industry. Now, before I move on to our projections, I would just like to talk a little bit about the semiconductor cycle. So what goes up must come down. This is a principle that holds true for the semiconductor industry as well, but with a little twist. So while the chip-making industry is currently basking in its moment of glory marked by rising share prices and sales growth, seasoned investors, you'll know that this industry is no stranger to cycles of ups and downs. So to recap, semiconductor cycles, they are essentially driven by fluctuating sales growth numbers, and that actually stems from imbalances between supply and demand. There are a couple of factors, but for the most part, these imbalances, they can be explained by the over and underestimations in production levels. So when times are good, chip makers, they tend to overestimate demand, invest heavily on capacity, and produce more than what the market can absorb. But over time, this high level of production eventually becomes unsustainable as inventory starts to build, leading to an oversupply. So when this happens, the natural thing that these companies will do will be to slash prices, cut down on inventory, reduce their capex spending, and all these things will cause sales growth to fall even as demand remains relatively stable. But just like how chip makers have the tendency to underproduce when times are good, to overproduce when times are good, they also have the tendency to underproduce when times are bad. So put simply, it is this excessive adjustments in production levels that leads to fluctuating sales growth numbers, and that is a characteristic that defines the cyclical nature of the chip industry. There are, however, a couple of silver linings that I'd like to highlight. So first of all, the semiconductor industry has grown to become less cyclical and more structural. So if you look at the chart on the left, you can see that the recent down cycles, they have shown milder declines in sales compared to the past, with growth during up cycles far outpacing these contractions. So unlike the past where semiconductors, they were only found in a handful of devices, mainly your computers and simple consumer electronics, and in relatively smaller amounts, semiconductors, they have practically become ubiquitous these days and are found abundantly in numerous different applications like your self-driving vehicles, data centers, your various consumer electronics, so on and so forth. So this essentially means that this diverse range of end-use products, it helps to mitigate the impact of a downturn in any single segment, and that effectively makes the industry less cyclical than before. So the second piece of good news is that down cycles are unlikely to last forever. So if you take a look at the chart on the right, you can see that history has shown that after every single downturn, chip sales have continued to forge higher highs and lower lows, which again is most likely due to the structural factors that I have mentioned earlier. So ultimately, we are confident that the long-term growth story for semiconductor stocks, it remains intact, and semiconductor sales will only continue to trend higher as the years go by. So the next time a down cycle comes around, the first thing you should do is not to panic sell. First thing is to assess whether this downturn is caused by temporary structural factors, temporary cyclical factors, or something more structural. If you assess that it's more temporary, then I think it can be a good opportunity to buy instead. So moving on to our projections. So with such a promising outlook for semiconductor stocks, we continue to believe that chip stocks, they can continue to deliver good returns for investors. And no doubt, valuations, they have gotten more expensive over the past year following their impressive share price performance. However, they are not overly expensive yet, especially if you take into account the level of earnings growth that these companies can deliver, which, by the way, is on average, it's about 30% each year over the next 2 years. So at iFAST, we are long-term fundamental investors, which is why we always pay close attention to valuations and earnings, as they are the key determinant of share price movements in the long run. So over time, we think that semiconductor stocks could also see more positive revisions to earnings estimates, and that should lower their valuations. This could also be accompanied by further multiple expansion due to improved market sentiment or investor confidence in this sector. So it's understandable that some of you may be concerned about the high valuations and you don't want to invest. And you want to wait for a pullback to buy. That's perfectly fine, but I have to say that there is no guarantee that pullbacks will materialize. So instead, what we recommend for investors to do is actually to adopt a dollar cost averaging strategy while keeping an eye out for sharp pullbacks to make your lump sum investment. So this approach essentially ensures that if the sector does indeed go on a run, you are still able to benefit to a certain extent. So with growing demand, solid fundamentals, and significant government backing, we believe that the chip sector is well positioned to thrive. And we are going to reiterate our view that semiconductors, it will be one of the top performing sectors over the next few years. So I hope that what I've shared today resonates with you. So let me sum things up by saying that semiconductors, they are the bedrock of all technology, past, present, and future. And if you believe that the world is going to become increasingly tech-driven, then I think by default, you should also believe that semiconductor demand is going to increase exponentially. Because without semiconductors, the technology that we enjoy today will not exist. And that is essentially the message behind this image over here. So just a fun fact, I actually generated this image using AI. It took me several prompts to get something I want, but I think this essentially encapsulates the message. So in the middle, you have your semiconductor chip. The guy in white is actually the electrical engineer who makes this chip, and surrounding the chip are the various technology that it supports. Your cars, your electronics, robots, so on and so forth. However, if you have a sharp eye, you'll notice that there's actually a spelling mistake at the top. It says semi-coolers instead of semiconductors. I assure you, I know how to spell, but after multiple tries, I still can't get the AI to correct this seemingly simple mistake. But in the end, I decided to leave this here as a timely reminder that even though AI has a lot of potential to bring more good to our lives, improve productivity and efficiency, it is not 100% reliable at this point in time. I think human input, human judgment, it is still necessary in most, if not all cases. So if you're worried that your jobs are going to be replaced by computers soon, I think you can relax a little. So with that, ladies and gentlemen, I've come to the end of my sharing today. I'd like to wish everyone all the best in your investing journey, and I'll see you again next time. Thank you.